Welcome to everyone for the quarterly call. It's been a few weeks since we've been planning to have the call. There's been a lot of travel at our end, but I guess the time is good now. So over to you, Manoj.
Yeah. Good evening, everyone. Thank you for joining. So now the pattern that we have set for ourselves is that we speak for a little while on what is happening at the global level, and then we come down to the scene in India, and then we will discuss about our portfolios, etc. So let me start with a global roundup, starting with the largest economy, that is the US. Numbers wise, US is looking okay. It's recorded a 2.4% growth in annual GDP this quarter, which is the best, at least in the last 5 quarters. And this has been largely aided by government spending. Inflation has softened, but it's still higher. But because we see consumer spending being relatively lower, we are also seeing a decline in core inflation. So we are having a scenario in US where there is growth, positive. We are no longer talking about recession, etc. We crossed that stage, and inflation is not shooting out. Seems to be in control, but we do have issues. Interest rates continue to remain high, and it is unlikely that we will see a drastic fall in interest rates, at least in the current calendar year. We may not see any cut in interest rate. Actually, Jerome Powell talked about an increase in rates. So rates will continue to remain high, and that will have a major impact on global markets. This is an election year in the US, and typically in an election year, US markets are volatile, but with an upward bias. So we generally see markets going up in an election year. Whether it is by design or default, we do not know, but that is usually the trend. And a related trend is that the rest of the markets, global markets, particularly emerging markets, actually outperform the year after the presidential election year. So if we are having elections in 2023, then 2024 is likely to see global markets outperforming. But as I said earlier many times, past is no indication of the future. So this is just an observation that is to be made. Now, what it means for us. Of course, we will talk about India a little later, but given high interest rates in the US, the flow of money from advanced economies such as US into emerging economies like India gets negatively impacted. Now, there is an expectation of a further depreciation in currency simply because interest rates in the US are higher. So someone who has to take out money from US, invest in India, earn return in India, and again take it back to US, converting it into dollar, that person has to earn a significantly high rate of return. And typically, fund managers are little averse. And when the fund flow is not that strong, it impacts currency as well as markets because it impacts liquidity. So interest rates changing course in the US is a very important aspect from our markets point of view. Okay, but we will see how this is going to happen. Particularly, the expectation is that we will have 2 interest rate cuts early next year by the new president, whoever it is. But this is all, speculation, because we really do not know how the economy is going to be and who the new president is, what will be the new policies, etc., etc. But we are talking general terms based on what we have seen in the past. So most elections, we are likely to see an interest rate cut, and that should result in more flows into economies like India, and that should further propel the global markets, particularly Indian markets. Scenario outside of the US is not that great. The UK and Euro area are, I should say, struggling. Growth rates is less than 1%, 0.6% in UK and 0.5% in UK in the Euro area, with inflation significantly higher, and as a result, interest rates are also very high. So these numbers do not augur well, and what it means is that global economy will continue to grow slowly. We are not going to see some fast growth across the globe, particularly with these economies not doing well. Japan is doing relatively well. It has still managed to hold on, I would say, unrealistically to lower interest rates. As a result, the currency has depreciated significantly. In this calendar year, I think they've suffered almost 15-16% depreciation. The yen has gone down against the dollar. But the growth continues to remain slow. For Japan, it is still good because Japan has had a very long period of negligible growth. So with their policy of keeping the currency undervalued, etc., it's kind of working, but inflation is above comfort levels. China is also struggling. It is no longer the fastest growing economy or how it used to be earlier. That crown has probably been taken by India now. India is the fastest growing economy among the major economies. But there are some challenges in China. China is being aggressive about it. China has cut interest rates that should result in, and they are aggressive with their policies also. So we should see China bouncing back. And if China bounces back, that will be kind of good for the global economy. But otherwise, we can, looking at these broad economies, conclude that the global economy is continuing to face challenges. We are resorting to monetary controls, but the solution probably lies on the supply side, and that is what all central banks and governments have to work on. But as things stand today, inflation pressures continue, and the IMF has forecast that growth in the coming year, that is 2024, is likely to be lower across all economies. So global economy is likely to grow slower by about 50 basis points or so. Now, India, thankfully, fortunately, presents a totally different picture. The Indian economy is seen as resilient, and growth is continuing. We've logged in some very strong numbers. Our GDP for the that is Q1 Um, only China and everybody else below 5%. You already see numbers. At 7.8%, India really stands tall. And the inflation scenario is again, I didn't see. Times we have in suddenly inflation. How the it rains, and we really do not know if we just have to see the average rainfall, and if the Met declares that we have had a normal monsoon. There's no such thing as a normal monsoon now, because we don't know whether there have been excess rains in some quarter and shortfall of rains in another quarter. So we really do not know the impact of monsoon on agriculture. So this can again impact growth rates in India, and particularly because of food inflation, we can see higher numbers and inflation. As of now, things seem to be okay. Okay, the current account deficit is another area where things are not looking very good. Our current account deficit currently stands at about 2.6% deficit. And this is because, again, global economy has slowed down. So our exports are not picking up. But as a policy, what India is doing is that it is trying to reduce its imports, trying to be more self-sufficient. There is a conscious effort, obviously unspoken, nobody talks about it, but you will see that you will not find the rupee appreciating. That is about having all the macro fundamentals attractive enough for investments to come. We will not see a lot of into India, and as a result of the exchange rate actually improving. I shouldn't use the word improving, because the exchange rate is not a reflection of the situation. As an economy, we have been following this policy, unspoken, unwritten policy of keeping the exchange rate down. That is what we have done, and we have also tried to keep our exchange rate relatively lower. We will, in my opinion, never see again the dollar coming in 70s. Okay, it will be in 80s, then mid 80s, and then higher 80s. But we will see a dollar 27, etc. That is one conscious on the current appreciate. Why to appreciate? Because we want to compete in external RP and to come down price. Still a lot of it sensitive and to be favorable. So we want to keep the exchange rate low. So and on the other side, we are trying to enhance our manufacturing capabilities. The Make in India initiative, the PLI scheme, etc., is aimed at increasing the volume of production, increase manufacturing, which will result in economies of scale, lower prices, and coupled with an attractive exchange rate, we should be able to capture a higher rate in the global markets given that global markets have slowed down quite a bit. So while this is a strategy at work, as of now, we are seeing exports not up significantly or not as much as we want to. But our policy of import substitution and reducing the reliance on major import products such as oil, etc., is work in progress, but I feel it is working well also. So currently, the current account deficit is, the number is alarming. We don't want a 2.6% deficit, but we should see improvement in this number. And paradoxically, economists believe that an increase in imports is a good sign for economic development. We will not go into the theory, etc. But so having this situation is not so much of an alarm from an economic analysis perspective. India shows a lot of promise, particularly because of the quality of work that is happening in India. Today, we can say India is the global hub of startups. About 1/3 of world's unicorns are in India. We have about 115 unicorns. So there is a environment that is encouraging entrepreneurship, encouraging startups, and this should see a lot of this will see a lot of contribution towards our growth. Focus continues to be on renewable energy. I spoke about our strategy of reducing our dependency on oil. That is our major import item. So with more focus on solar energy, wind energy, etc., we are trying to use it. Not only helps in having sensitivity to climate, but it also helps us to reduce our import bill purely from an economic point. Then we've been working on various initiatives. We are trying to reduce the dependency on dollar through doing trades on rupee terms, etc., etc. So what we are seeing is a more assertive India, a more credible India, a more attractive India from an investor's point. So India continues to be the bright spot in the gloomy global scenario, and therefore it should attract investors. Now, while this has been the scene, I have already said that we may not see a lot of money coming in, primarily because of the higher interest rates in the US. Okay, so a global investor will want to play safe and park his money in US, primarily because of higher interest rates and because of the historical reasons of higher returns in an election year. So we are not seeing a surge in, say, FIIs, foreign institutional investment into India. But 2024 should this. 2024, we should be seeing a lot of money coming into India. And we should be able to see, although the IMF has forecast for the coming quarters, for the coming year, they are likely to be lower. Our reading of the situation is that actually we will be doing a much better job, and our growth rate should increase. So a lot of positives going for India. Challenges we have already talked about. Just 1 second, please. Hello.
Manoj,
Sorry,
your voice is not clear. Can you?
Yeah, is it better now? 1 second. Call me after 1 hour, please. Ram, is it better now?
Yeah, slightly better now. And also, can you step back so that your face is too close to the camera?
Okay.
Yeah, and tilt the camera down a bit. Yeah, yeah.
This is better. Yeah.
Yes, yes, yes.
Okay. Sorry about this. Okay. So we were talking about challenges for the Indian economy. One, we've already discussed monsoons and mm, uh, you know why the FI flow is not there as of now, etc. But among other things, we also have to be cognizant that we also are having an election in the coming year. So 2024, we will have general elections. And again, typically, if you look back, pre-election period, there is a lot of uncertainty. Investors are unwilling to commit investments during this period. Now, again, our history shows us that irrespective of the government which comes into power, most of our reforms are irreversible. Policies are more or less the change, a little bit of tweak here and there. But given the high decibel electioneering that happens, investors are left with a lot of uncertainty. And one thing that the investors do not like is uncertainty. Tell them that this is not going to happen, they'll leave it. But if we do not know what is going to happen, that is something that makes everybody uncomfortable. So till the elections are done and dusted, we will again have a relative slowdown insofar as investments are concerned. Thankfully, the government is going full throttle, and a lot of our growth is fueled by high government spending, particularly capex. Another area which can be a major challenge for India is the inching up unemployment rate. Our unemployment rate is slowly crawling up, and while we are having so much of opportunities, we talked about a startup culture, we talked about growth rates being the highest in the world, we are fastest growing economy, etc. But if we are unable to absorb the youth into productive activity, then there is a chance that this can lead to exploitation, class conflicts, civil unrest. And this is something that the government has to watch out for, and we as investors have to be wary of. We don't want a situation where suddenly the country is facing a lot of civil unrest. So food inflation and monsoons we have already talked about. Exports remaining subdued despite all our efforts we've already talked about. So we will continue to have challenges despite, it's like, since the World Cup is coming, I will give a cricket analogy. It's a the batsman has got great potential. It is a very good batting wicket, high scoring possibilities. But then you also have a very difficult and wily bowler in front of you, and you will have to find your way out of the situation to realize your full potential. So, all in all, macro roundup, we should be doing very well. And as we have been maintaining, the next decade or so, India will definitely, uh, the growth rates are going to be tremendous. To quote our external affairs minister, we have entered the Amrit Kal. So we broadly believe in this story. We are very, very invested into the India story. But we also have to be cognizant that there will be challenges. And these challenges will mean volatility. So markets are going to be choppy. Markets are going to be, up and down. Suddenly some news comes and then we can see sharp dips. But that is something that we should not be worried about. Okay, just invest in right companies, keep looking at your portfolio. Don't be worried about the noise that is being created by the macro factors. Okay, macros are important, but company managements should be smart to take care and adopt to those macros. And that is what we as advisors focus on. We look at companies with strong, as all of you know, roots and wings, and that should help us sail through this situation. Over to you, Ram.
Yeah, thanks, Manoj. At this point, I would like to see if there are any questions. Please feel free to type them in the chat window. Let me see if there's anything that has come up already. Yeah. So I think, like Manoj said, the last 12 months have been very turbulent. Markets have been on a upswing in the last few months. If you go back and see our previous calls, Manoj has been always saying India growth story is intact, please stay invested. FY 22-23 was a very, very testing year for us. But then since April 2023, which is the current financial year, our portfolio is up more than 27%, 25-27%. The jewel portfolio, Spark, is up nearly 40% in the last 6 to 9 months. So we've seen a good revival. There is some trepidation among investors. There's a lot of social media chat that markets have peaked and time to exit and all of that. I mean, we would like to request our investors to, ignore the noise and continue to stay invested in good stocks. We are not doing any speculation here in the core strategy. We are not trying to do quote unquote trend following. We are basically focused on fundamentals and building a long-term portfolio as far as our roots and wings investment philosophy is concerned. As you all know, we call roots as companies with strong balance sheets, ideally zero debt, consistently high return on equity, growing earnings, and good management, management with sufficient stake in the company, etc. And so this is the roots and wings philosophy. And I think there are times when a particular philosophy will not do well. Financial year 22-23 was one such year where our philosophy was tested for its patience. And I must say that since then, the recovery has been good. I can share some numbers, briefly in terms of what we have seen. But just suffice to say that since inception, the portfolio is up nearly 23%, which compares very well with 15.5% of Nifty. This is the jewel portfolio, and Spark portfolio is up nearly 25.5%, whereas BSE small cap is up around 22%. Now, obviously, I mean, any investor who comes in at a market peak will have a different experience. I'm just talking about the model portfolio from beginning to end. We have also been working on another strategy. As you all know, we've been in these portfolios. The jewel portfolio is more than 4 years old. Spark is now 2.5 years old. We have been very, I would say, conservative and slow and steady in terms of evolving our strategies. We are very comfortable with the roots and wings, the quality of portfolio. We keep talking to other people in the investor world, and we are very comfortable with the feedback we're getting on our portfolio. Now, because we are very strong on the tech side, I mean, both Manoj and I come from a tech background as well, in addition to our financial services and the MBA world and all of that, and the practitioner world. So what we've done is we have crunched a lot of data on the markets over the last, that's available over the last 20 odd years. And we are now launching a new strategy, which we call as growth in equities through momentum. The short form is GEM, G-E-M. And the reason why we are talking about it now in an open forum is because we are comfortable in terms of how it can be executed. We've done thorough backtesting. Earlier, we were not too sure about how this will work in the advisory model, because as you all know, in advisory, there is a lot of follow-up. We send you the portfolio, you buy, and then in rebalancing, you sell. And because SEBI rules have changed over the last several years, the last 3-4 years, SEBI has been changing rules in terms of how advisors should work, how the securities market should work. So earlier, rebalancing used to be a one-click, in one click, finish off all of rebalancing. Now what happens is you sell, then you get 80% of it on the same day. You can buy only 80% on day two, because the 20% is held as margin. And, on the second day, you then get the remaining money available. So rebalancing requires a lot of hard work from you and us. So this is the reason why we went ahead and applied for a portfolio management service license with SEBI, which was granted in a very short period of time. I think we got it in just 5 to 6 weeks of applying. And we got it in the month of March. And, we took some time to set up the processes, etc. Now we already have quite a few clients have migrated to the PMS model. And new clients are coming in that. The reason why I'm mentioning this is the GEM model, and I'll share some data about the momentum strategy. I'll share my slides right now. The reason is there is a lot of monthly rebalancing here, and that needs to be done on a regular basis. So I'll quickly cover this, and then we'll come to the question. Manoj, there's a question from Chaitanya on the economic impact of budgetary freebies. We'll come to that. Let me take about 5 minutes to finish off GEM. I'll give priority to only questions, and I'll not do any other small talk. Let me share my screen. Manoj, you'll have to make me the host again, because I lost the connection.
You're the host now.
Yeah, thank you. So I had put together a few slides for this call. Let me now share this.
We can see the screen now.
I just wanted to make it big. Yeah. This is the Jewel performance since 22nd August, the model portfolio that I talked about. And this is the Spark performance. We do see a certain rhythm in how the markets move and up and down. Coming to GEM, see, momentum is Pharma and French are supposed to be the people who talked about the efficient market hypothesis, and they are their whole concept was that in the long run the market is efficient, and therefore all prices will like water finds its level based due to gravity. Similarly, market will always find the right price. But they do acknowledge that there are many anomalies, there are information asymmetries in the market, and they identified momentum as the topmost anomaly. Now that's something that they told 40-50 years back. On momentum, you will find a lot of research papers. We've, in fact, studied many research papers, more than 10 to 15 research papers. And it's interesting to see that momentum investing, so people say that it capitalizes on the continuation of existing price trends. So stocks that have done well over a period of time will continue to do well. So there are all kinds of momentum. There is price momentum. There is also fundamental momentum. Our roots and wings philosophy actually tries to look at fundamental momentum without using the word momentum there. We basically look at stocks where the roots are strong and the wings are powerful over continuous periods of time. In price, it's mostly price action, and it is not that it is just we are watching a price go up. There is a lot of intelligence of the herds involved here, and the momentum strategies are grounded in behavioral finance because they exploit investor bias, and people tend to buy a certain stock. We've seen in the market, for example, Adani group of companies will run for a certain period of time, and a lot of people will go and buy Adani. In fact, we've been asked this question several times, why are you not buying Adani, in 2021, in 2022? Our answer is that it does not meet the roots and wings philosophy. And that is something that we believe in. We didn't invest in that stock. But yes, some people did make a lot of money. But we do understand that there is room for another strategy where if you are able to buy winners and also are very prompt in cutting losers, then there is a good chance that you make good money. So our approach to momentum through the GEM strategy is we first look at the Nifty 500 stocks, then we score them based on momentum. And here we have employed various types of linear regression and exponential scoring techniques looking at prices. And this we've done, I mean, we must have run, thousands and thousands of simulations. And we are comfortable with a certain type of momentum scoring. I can't tell you exactly the scientific algo behind it, but we've tested it thoroughly. Now, the interesting thing is that we found that just applying momentum on a 500 basket stock and picking the top momentum stocks results in heavy losses. Unless we couple it with roots and wings philosophy, where we are picking companies with strong fundamentals along with this, chances are that this won't do well. So we therefore we don't for Jewel and Spark, the kind of stringent scores we apply, like we expect a 95 to 100 percentile percent mapping for Jewel and Spark. For momentum, for GEM we have relaxed it, but we have kept it, and we found that removing it results in a very bad result. Keeping it at a moderate level gives a good result. Now, on top of it, we've kept monthly checks for mean reversion, and I'll talk a little bit more about that. And then the final portfolio comes. So we rebalance it both on a monthly basis and a quarterly basis. Okay. The idea is to hold the stock for at least 3 months. But then if the weather changes in terms of the market mood changes, then we will move to cash quickly. We have established a lot of guardrails in this, roots and wings. Stop losses also we've kept. And we've also put in sensors for bear markets. So when a bear market is happening, for example, if a momentum strategy is giving just 1 or 2 picks, it doesn't make sense to jabardasti invest in those 2 stocks. We might as well move to cash, or at least increase cash, rather than just putting everything in those 2 stocks. And so we've put a lot of this, and the backtests have given these results. Yeah. So this is the, and I'm giving examples of multiple scenarios where we ran one historical scenario from September 2006 till August of this year. And we found a healthy CAGR, and all these numbers are all before costs, taxes, and fees. Okay. But even if you're given allowance for that, we found a decent CAGR between GEM and Nifty 500, which is the universe we are picking up from. And there is a good drawdown comparison also. In many cases, we've been able to, for example, have a better drawdown both during COVID and during the global financial crisis. Okay. There are times when the market confounds everything. For example, the NBFC crisis in 2018 and also the small cap crash in 2018, both are roughly in the same time period, which you will see in row number 2 and row number 4 here. Both we have underperformed. Okay. But the remaining times, we've done really well. So ideally, you may want to count these 2 as 1, but I still kept them as 2 because you see there's a decent overlap here in terms of the row number 2 and 4. but we found, I mean, this is an interesting strategy that we thought we'll present and share these findings. We are pretty excited because these numbers are looking pretty good, and the CAGRs, and we've made a conscious effort to limit churn. In the long run, we've seen that a churn in the 30s percentage is there, which is pretty high. So, which is one reason why we recommend that this runs. We are likely to engage a brokerage, a demat or a brokerage firm where the demat, the brokerage costs are extremely low. The cash component, as you can see here, there are, we have used cash component here. There are times when the strategy goes into cash. There are times when, let us say, the market has crashed. It's very difficult for anybody to predict when the market is going to crash. And it is going to be extremely difficult to even predict when the market is going to recover. That is, so we are basically saying that we have to bow our head in front of the markets. Nobody can predict. Having said that, in this strategy, we've deployed a trigger which can tell us when is a market likely to recover. And in such a position, it will be very, very difficult for anybody to pick 5 stocks that will lead the recovery. However, the index will recover, which is why, this strategy for a few months in recovery even explores buying the index itself for 2-3 months. And if you read the research papers, the term that people use for this is called the recovery premium. So I don't want to miss on a 30% recovery trying to pick a particular stock, especially because please understand that when the market has fallen and is recovering, there is no momentum to track. Momentums have all dissipated. Momentum again builds up. Momentum will always have a lag effect. But once the recovery has started, then my momentum strategy will work beautifully. So we have taken into account all of these. When market is falling, figure out, move to cash. When market is likely to recover, figure out, try to encash on the recovery premium by temporarily entering the index. And then when recovery is underway and momentum signals are again picking up, then go catch momentum. So that is in a nutshell this strategy, and we're pretty excited. We plan to launch this on Vijayadashmi Day in the next few days. So that's about it on momentum. And I think what Manoj said is earlier in the call is very, very true. If you are following a long-term strategy of buy and hold, like for Jewel and Spark, buy and hold is our recommended strategy. They're difficult to time the market, so stay invested, and we'll definitely see the recovery that we saw in the last 6 months, 8 months in the market. With the momentum strategy, it needs a more nimble footness, and therefore we are offering it only in the PMS container. And now that we have a PMS, we are able to offer it. So that's in a nutshell from my side. Manoj, back to you. Can you please talk about the economic impact of possible non-budgetary freebies given the 2024 elections?
Okay. So let us look at, we don't know what kind of subsidies will come from which party, etc. But let us classify these subsidies into 2 categories. One, I promise to give a laptop to all students. 2, I promise to transfer 3,000 rupees to all unemployed people. Now, what is the difference between these 2 freebies? In the first case, the laptop is not going to come out of thin air. The laptop will have to be purchased. So there is a company which will be producing the laptop, and the subsidy giver, which is the government, will actually have to pay money and buy the laptop. So there is economic activity happening. So there is an increase in GDP because there's an output, and that output is being consumed. And as per your formula of GDP, that will get accounted for. The question there is, from where is the money going to come from? And this is common for the second case also. In the second case, what is happening? The government says, I am transferring 3,000 rupees per month to unemployed people. Now this is coming out of thin air. There's no economic activity happening. The money is just being given by the government to the receiver of subsidy. So in both cases, the government is footing the bill. And from where is the money coming? The money is coming just by the government willing that I will spend. And the government can either fund it by way of borrowing money from banks, etc., or it can simply create new money. Now, the government doesn't create new money. It is the Reserve Bank of India which creates new money. The government borrows from Reserve Bank of India. Essentially, what is happening is the government is committing to expenses without having any money to actually meet those expenses. So this will come either by way of borrowing from the market, and if that happens, it will have a significant impact on liquidity because the government is perceived as the most safe borrower, and therefore money goes into the borrower's account. A private businessman will not be able to compete with the government, and therefore will have to offer higher interest rates. So liquidity will dry up, interest rates will go up, which is bad news for the economy. But typically what happens is the government is also wary of taking loan from the market because it has to actually repay. And interest costs again form a substantial part of the government's expense. Therefore, what the government does is it conveniently borrows from the Reserve Bank. And how does the Reserve Bank of India fund money? It creates money. Take out a 500, 100, 2000, whatever currency note you have. On that it is written, signed by the Reserve Bank of India governor, that I promise to pay the bearer a sum of rupees, whatever that currency note is. So that paper is not 100 rupees. That paper is worth 100 rupees because we trust the Reserve Bank of India. So that is a loan which the RBI is taking by creating this currency and giving that loan to government. So if you are an accountant and if you understand the balance sheet, the RBI has got one asset, one liability. The asset is loans given to central government, and the liability is loan taken from the public, because all this.
Manoj, sorry to interrupt you. In the interest of time, can you come back to the impact on
Yeah, I'll
elections?
come back, but I have to explain. Sorry. I'm really sorry for being the teacher in me comes out.
Yeah, I'm trying to moderate that.
So essentially what happens is the Reserve Bank of India is taking on a liability which it knows that it does not have to honor. And it is not just with RBI, it is with the Federal Reserve, it is with any central bank. No, the people of the country do not question or challenge the central bank of the country to say, we don't have faith in you, give us back the money. Whatever currency that central bank has printed, that is the money. And therefore, what happens really is that there is no impact. Okay, hard truth, economists will shout at me saying that, what are you saying? This will cause fiscal deficit, we'll understand that. But in reality, what happens is when a state government gives subsidy, it is conveniently passed on to the central government because it draws money from the central government. State governments can't create their own money, so they borrow from the central government. Central governments don't create money, they borrow from the central bank. Ultimately, new money is created and no one is accountable for this money. What will happen is, if this money, a lot of money is coming into the economy, that will again give rise to inflation because there is no matching supply. There's a lot of money pumped in, everybody gets 3,000 rupees unemployment allowance, they'll want to spend. But what will they buy? There has to be something. So unless there is a supply side match, this will result in inflation, which is again bad news for the economy. Fiscal deficit will go up, which should result in deterioration of your currency. In reality, another total different dynamics control your exchange rate market. So your fiscal deficit, your credit rating, etc., is one. It's like a poorly performing company's stock price goes up because investors perceive it to be a gold mine which will result in great performance in future. So there is that theoretical link between what will happen if new money is printed and therefore the impact of economy in reality is not working. And therefore, governments are actually getting away by giving these freebies, etc. So long story short, Chaitanya, what will happen is nothing will happen. Okay, life will go on. We will not feel the pinch. So long as fresh money is coming in, so long as India is perceived as a great investment market, etc., nothing will happen. Suppose India's stars weaken and again suddenly there is a change in perception, then every economist worth his salt will criticize the policy, will say economics have been taken to the whatever, and credit rating will get downgraded, interest rates will shoot up, currency, everything will happen if the perception of India's growth is distorted. So long as the world believes in India and India's story, nothing is going to happen. Sorry, this is not an economist's view, but this is the practical view of how the markets are going to function. Because this US government will stop because Congress is not passing the expenditure. This drama is happening year after year or every 2 years, particularly before election year. Nothing happens. Ultimately, the Congress will pass for higher budgets and spending will happen.
Any other questions anybody has?
Chaitanya's comment is there that we are 36% of our budgeted fiscal deficit. See, this number will keep changing. Sometimes it will go up to 80%, etc. But what we have seen is that there is tax buoyancy. Our indirect tax collections are higher than budgeted. And last time in my con call also, I had said that despite a higher budgeting of tax revenues, I said that we are likely to achieve these numbers. And with GST, we are actually doing better. Direct tax collections are slightly lower, but again, with advanced tax collections, etc., we are likely to be more or less near, if not more than what we have budgeted for. And as a result of that, because of the typically what used to happen earlier was we used to have very optimistic budgetary numbers, and reality would be very different. And therefore, our fiscal deficit, etc., would reach 80%, 90% by mid of the year. Today, we are at 36%, which means we are exercising restraint, or maybe we are holding back some expenditure. It will eventually happen. But what the bigger message that I'm trying to give you is nobody will care for fiscal deficit. If we had to really give credit to fiscal deficit and its impact, etc., then India would have seen a sharp cut in its credit rating 2 years back. That bluff has been called, and while we'll all pay respects to fiscal deficit as a theory, etc., in reality, even if we should go beyond the targeted fiscal deficit, nothing is going to happen. The show will go on.
Thank you, Arijit, for the comment. Arijit Kumar Gupta. Our friend Sridhar has a question. What is the new PMS strategy? Sorry, I missed the initial part. There was another call. Is it a combo of gem and momentum? Did I hear it that it is being launched on Dasra Day? Yes, Sridhar bhai, we are. It's a momentum strategy that also combines our roots and wings philosophy. So we pick from the Nifty 500, and then we look at fundamentally good strongs, which are also scoring high on momentum. We look at good momentum. As soon as the stock loses momentum, we will exit that stock. But it's not that we are exiting it immediately. We'll give it at least 3 months to play. And then at the end of 3 months, if it doesn't, then it goes. Meanwhile, the problem with momentum strategies is that when market falls, portfolios get wiped out. So what we've done is we continue to check every month for momentum signals, and if momentum signals are tending to reduce or evaporate, then we instantly go into defensive mode. Okay, we'll either move to cash, we'll pretty much start increasing the cash component of the portfolio in such times. And that tries to mitigate the first risk of sharp falls in market. The second big risk is missing on recovery, which is why typically an SIP model works really well. A monthly SIP in equities works well because you ride through this. But with momentum strategy, like I said, one is trying to protect yourself when the falls happen. Second is not missing on recovery. So, and that's extremely difficult to catch, because when a market has fallen, you take it, and of course, COVID was a very sharp fall and sharp recovery, but many falls tend to prolong for months together. So you will lose momentum signals. And when the real recovery happens, and all momentum indicators are typically 3 months, 6 months, 12 months, they look back for that much duration. You won't get signals. And jab tak market udta hai, right? By then you would have missed that 30-40% juicy recovery. So what we have done is we've figured out, we've put some logics which will tell us when a likely recovery is underway. We'll never get it 100% right. We'll probably get it with 1 or 2 months lag. But then even then, if you jump onto the bus, then you will make some good money. And then the bus here will be the index. So we'll temporarily jump onto the index for a month or 2 months. Maybe 1 month itself is enough. And then after that, once momentum signals pick up, then we pick it up and ride. So this strategy has given us pretty good results. And we are offering that in the PMS model. We also offer Jewel and Spark in the PMS model. The advantage for clients is that the fee can be linked to performance. Unfortunately, with the new SEBI rules, the advisory fees cannot be linked to performance. So that's the reason why we're encouraging our clients with portfolios more than 50 lakhs, 70 lakhs, 1 crore to consider the PMS, where we are ready to give a fee which is as low as 1% with a hurdle linked to performance, as opposed to the 2.5% which is there in the advisory model. So, and the momentum strategy we'll offer it only in the PMS, because the rebalancing actually happens on a monthly basis, and that's a lot of work for my ops team as well as you. So the best way it is in a PMS model. I can share more details later with you, Sridhar bhai. Anupama has a question. I sorry I missed that. Out of the subject, but wanted to know how can big investors and venture capitalists miss out on inflated valuations of IPO-driven companies like Nykaa and Zomato? Sorry, ma'am. Yeah, can you clarify the question, Manoj?
No, essentially what she's saying is that these IPOs come with very high valuations, but how come the educated and knowledgeable investors, venture capitalists, the sharp guys, how can they not see that these are highly inflated? Is my understanding right, Anupama? Can you give a thumbs up if I have understood it right? I don't see a thumbs up.
Go ahead, Manoj.
Okay, so again, with due respects, regards to all the people there, here is my take. So in stock markets, we have a theory called a bigger fool theory. Okay, let us say a stock, for whatever basis, we are not going into it, a small story. Let us say stock is worth 20 rupees. And let us say one of your friends comes to you and says that, you know what, this is a great stock, I have bought it for 75 rupees. Now you are shocked. You say, Arey, this stock is worth only 20 rupees. Are you a fool to buy it at 75 rupees? Your friend says, yes, I am a fool to buy at 75 rupees because I know I will find a bigger fool who will buy the stock for 100 rupees and I'll make my money. Now, valuations, like beauty, is a subjective thing. Just like beauty lies in the eyes of beholder, valuation also lies in the minds of the valuer. So you look at a particular stock and its quote unquote potential. And Excel sheets are excellent slaves. You can get whatever numbers you want from your Excel sheet. So long as, understand that people in finance, venture capitalists, these big investors or smart investors or whatever way you want to call them, their objective is not promoting a company, doing good to the economy, establishing great brands. Their objective is making money. That's it. And if someone sees the potential in investing in an idea which people are willing to believe in, and they see that this can be invested in today and divested at a later date for profit, it is good enough for them. It need not be the fundamentals. People like us, we've been quite vocal. Ram went on board and said Paytm will go to 450 rupees. Ram said we will not advise investment in LIC. Now, these were big statements which were out of tune with what market was saying. But we stuck to our ground because we believe in our roots and wings philosophy and our fundamentals. But someone who is in this business who can perceive that yes, the price is going to move like this and there is enough demand and I can get out of this, will want to cash in. And it is their model. A venture capitalist has to earn big returns. A venture capitalist knows that if he is funding 10 companies, 6 or maybe even 8 will fail, but 2 will give enough money to recover the investment of all 10. So these are very calculated, very smart decisions that these big people are taking. And that is why we will have these kind of examples. When Nykaa listed, it listed at a premium. So there is always, and nobody is 100% right always. There are risks which these people take calculatedly. And we have to respect them for that. It is their strength. I hope I have answered. I don't know if I have ruffled some feathers.
She has given a comment in addition. You can read her comment.
Yeah. So that is what it is. So see, as I said, valuation is a perception game. So you have your expertise, you have your research, but end of the day, you are going by certain assumptions. Now take, for example, we as a company are very strong believers in the India story. Okay, we stuck our neck out, and con call after con call, we've been saying that we see the next 10 years as India's time, and you just have to invest to make money. That is our firm belief. Tomorrow, if this doesn't work out, then we'll fall flat. But that is our belief, our philosophy. So, and this is based on certain understanding of the economy. It's not that we are just saying something in thin air. Okay, we do our research, etc. So whether our research and expertise will actually come true or not, only time will say. And that is what is happening. Each of their organized. See, again, maybe this is little theoretical, but every trade, there's a buyer and a seller. And obviously, they are doing opposite things because they have different views. A buyer is buying because the buyer feels that the price will go up. A seller is exiting because the seller feels that the price will go down. Only one of them is going to be right. So both may be experts. And yet only one person will. So everybody has their own way of looking at things. Okay, end of the day, everybody wants to make money. Some people will succeed, some people will not.
So by the way, I didn't predict the Paytm stock price. As usual, when media does an interview, they will quote one small thing. So I was asked, will it touch 450? I said, yeah, it might. It was around 700 in those days. And it did go down to 460 and then it moved back later. I think, but the key here is, Anupamaji and everyone else on the call, is that, we believe that in the investing business, one has to stick to a philosophy. Okay. If I'm saying that for Jewel, I'm going to pick 20 stocks and I'm going to stick to roots and wings philosophy, I will stick to it come what may. And, any client, for example, I had a client call a couple of years back saying, why did you exit Balaji Amines and why did you buy this stock? And, so I had all the data in front of me and I showed it. So we've, in the last 4 years, right, we must have taken a few hundred decisions and there is data backing every decision. So we stick to the philosophy. Now, we took another 4 years to launch the momentum strategy, but believe me, we have very, very finely detailed out rules in terms of what is momentum, when will it enter, when it goes down, do I have graded momentums, what happens when market is crashing, when will I be in cash, when will I be in Nifty, what is recovery? We have mapped out everything. So tomorrow, if I'm going to buy a stock or exit a stock, I have clear reasons why this happened. So it's very important to do that. And I think as it's our moral duty not to tom our stocks after we buy them. Some PMSs do it, but I think it will be very, very ethically wrong on our part when we say, please buy Asian Paints and we announce it to thousands of people, lakhs of people. And then when I'm selling Asian Paints or when I'm selling Relaxo, I don't tell all of them that I'm selling it. So that is unfair. So please be careful of people who claim they have large teams, research teams, and then who publish their stocks and say you keep buying, and they will not tell you when they're selling. So I think just like big finance, big healthcare, big pharma, big food industry, all of them have huge vested interests. The same goes in the investing space also. I think we have spent an hour on the call. We started 4 minutes late, but it's 4:04 to 5:10. I'm just checking if there's any other question that has come in the chat window. All right, if there's nothing else, we'll close the call and have a happy weekend, long weekend, and wishing you all a great Dasara Navratra, and talk to you soon.
Okay, then see you. Bye, everybody. Happy investing.
Happy investing.